Hey guys, imagine this. It's September 2008. The financial world is already on fire, with Lehman Brothers collapsing. And suddenly the biggest bank in America, Washington Mutual, a household name for home loans, gets seized by the government overnight. Depositors panic, billions vanish, and shareholders wake up to find their investments worth pennies. This wasn't just any failure. It was the largest bank collapse in US history. A total meltdown that cost taxpayers nothing but exposed the rotten core of the housing bubble. How did a bank with roots in the Great Depression turn into a subprime monster? Stick around for this full 10-minute deep dive, because we're re-breaking it down step by step, with the shocking numbers that made WAMU's fall legendary. By the end, you'll see why this was the ultimate warning sign we ignored before the entire 2008 crash. Let's jump in. First off, let's talk about why WAMU holds the record as the biggest US bank failure ever. It's all about that massive asset size at the time of collapse. Picture a bank so huge it dwarfed every other flop before it. As of June 30th, 2008, just months before the end, Washington Mutual had a staggering $307 billion in total assets. That's right, $307 billion. To put that in perspective, the previous record holder was Continental Illinois in 1984, with just $40 billion, and even Indimac's failure earlier in 2008 was only $32 billion. WAMU was like the Titanic of banks too big to fail, or so everyone thought. But when regulators stepped in on September 25, 2008, and handed it over to the FDIC, it became the largest insured depository institution collapse in FDIC history. No other bank has topped it since, not even in the chaos of 2008. Think about it. This was a thrift institution that started small in 1889, after the Seattle fire, grew into a giant through acquisitions, and ended up holding $188 billion in deposits alone. The sheer scale meant its failure sent shockwaves through the entire system, forcing the government to act fast to prevent a total panic. Crazy, right? If you're already hooked, drop a record breaker in the comments aisle. Read them all. Now, the real villain in this story: WAMU's deadly addiction to subprime and risky mortgages. This bank didn't just dip its toes into the housing bubble, they dove head. By mid-2008, out of their $118.9 billion in single-family loans held for investment, a whopping $52.9 billion were in those infamous option adjustable rate mortgages, option ARMs, where borrowers could pay so little that their loan balance actually grew over time. And on top of that, $16.05 billion was straight-up subprime loans, the kind given to folks with bad credit who couldn't afford them when rates reset. Add it up, and that's about 58% of their single-family loan portfolio tied up in these high-risk bombs. 58%. WAMU aggressively pushed these products, calling them innovative to boost profits. But it was a ticking time bomb. When the housing market started cracking in 2006, defaults skyrocketed. WAMU reported a $48 million loss that year, just from bad home loans. By 2007, they were hemorrhaging billions, with non-performing assets hitting $11.6 billion, including $3 billion in subprime junk. Executives ignored warnings, chasing short-term gains, while the portfolio rotted. It was like betting your entire fortune on a rigged casino game. Eventually, the house always wins. But in this case, the house was the crashing real estate market. How did they get away with it for so long? Deregulation in the 80s and 90s let thrifts like WAMU expand into risky territory without enough oversight. Mind-blowing how one bad bet can take down a giant. Okay, things get even more intense with the deposit run, the frantic stampede that sealed WAMU's fate. Starting September 15, 2008, right after Lehman filed for bankruptcy, fear spread like wildfire. Depositors, spooked by rumors and rating downgrades, started pulling their money out en masse. Over just 9 days, September 15th to 24th, customers withdrew a jaw-dropping $16.7 billion. That's 9% of their total deposits gone in under 2 weeks. And if you zoom out, since July 2008, outflows topped $22 billion. Imagine logging into your online banking and seeing everyone else yanking their cash. It's modern-day bank-run panic, but digital. WAMU tried to calm things with press releases and even a $7 billion capital infusion from investors like TPG in April. But it wasn't enough. Moody's had downgraded them multiple times, and by September, their stock was tanking daily. The FDIC watched as liquidity dried up. WAMU couldn't borrow anymore because no one trusted them. On September 25th, regulators seized the bank to stop the bleeding, marking the end. This run wasn't like the old movies with lines out the door. It was silent, swift, and devastating, all via apps and ATMs. What would you do if your bank was next? Scary thought. Speaking of the aftermath, let's dive into the fire sale to JP Morgan, the deal that saved the day, but highlighted how far WAMU had fallen. On that same fateful night, September 25, 2008, the FDIC sold most of WAMU's assets, the branches, deposits, and good loans to JP Morgan Chase for a measly $1.9 billion in cash, plus JPM, assuming all secured debts and some unsecured ones. $1.9 billion. Now, compare that to WAMU's pre-crisis glory, in 2007. Their assets were valued at $327.9 billion in SEC filings adjusted for inflation. That's like $476 billion today. Their market cap at its peak in 2007 hovered around $40 billion, with shares trading over $45. But by the time of the seizure, it was a bargain basement sale. JPM got a steal. Over 2,200 branches across 19 states, $188 billion in deposits, and a massive customer base, all without costing taxpayers a dime, since the FDIC absorbed the hit through its insurance fund. It was the ultimate bailout without a bailout. JPM even turned WAMU's network into Chase branches overnight. But for WAMU's leadership, humiliation. They went from being the 6th largest US bank to a footnote in JPM's empire. The irony. JPM's CEO Jamie Dimon later called it one of their best deals ever. Talk about turning someone else's disaster into your goldmine. Finally, the most heartbreaking part for everyday folks, the total shareholder wipeout. WAMU's stock price tells a tragic tale from a peak of over $45 per share in 2007, when the bank was riding high on the housing boom, to closing at just $2. On September 15, 2008, down 27% that day alone, and 95% off its 52-week high. By September 24th, it was clinging to $2, and after the seizure, it plummeted to 16 cents per share. Ouch. The holding company, Washington Mutual Inc., filed for Chapter 11 bankruptcy the next day, September 26th, listing $33 billion in assets, but only after the banking subsidiary was stripped away. Shareholders completely wiped out. Equity holders lost everything as the company restructured. Total investor losses. We're talking tens of billions. The market cap evaporated from around $40 billion at its height to virtually zero, with individual investors, pension funds, and even employees holding stock seeing their savings vanish. WAMU had lost $4.466 billion in net income just in the first 6 months of 2008, and projections showed $19 billion more in mortgage losses through 2011. It was a bloodbath. Shares dropped 92% in the year leading up, and folks who bought in at the top never recovered. This wasn't just numbers. It was real people betting on a safe bank and getting burned by greed and risk. So, wrapping this up, what can we learn from WAMU's epic fail? It was a perfect storm of subprime obsession, poor risk management, and a failure to adapt when the bubble burst. It exposed how deregulation let banks gamble with our money, and it is a stark reminder that too big to fail often means too big to save without pain. Fast forward to today, and we're still dealing with echoes and stricter banking rules, like Dodd-Frank. But have we really learned? Drop your thoughts in the comments. Which part shocked you most? The deposit run or the fire sale? If this deep dive blew your mind, smash that like button, subscribe for more financial horror stories, and hit the bell so you never miss one. Thanks for watching all 10 Minutes Your Legends. See you in the next video. Stay smart with your investments.